All righty, welcome back to the Smart Investing Show. It's now time for financial planning. For that, we always turn to our financial planning expert, Harrison Johnson, CFP. Today, I like this topic because it is December, and we actually do this throughout the year. But you're saying when tax loss harvesting makes sense and when it doesn't. It doesn't always make sense, does it?
It doesn't always make sense, and I mean, it depends on the situation, and I'll kind of go through when it might make sense. So, for example, if you can use a tax loss harvest use a tax loss to offset some gains that might bring you down into a lower tax bracket, that could be a good time to do it. If you're going to trigger some IRMA through your Medicare premiums, if you could bring your income down to avoid that, that could be helpful. If you have some short-term gains, you can maybe use some losses to offset those. Even long-term losses can offset short-term gains if you don't have any other long-term gains. So short-term gains are taxed at a higher rate, so that might be worth offsetting. But just because you have a loss in something doesn't mean it is a good thing to harvest that loss. A big part of what you need to look at is not the dollar amount of loss that you have, but the percentage of loss that you have. So for example, I've got some numbers here and I'm going to try and not keep it too wordy, but let's say you invested $50,000 into something and then it's declined to $45,000. So $5,000 loss, which is in this case 10%. If you're in California and you're in the 15% tax bracket, your all-in marginal tax rate might be 24.3%. So if you harvest that loss, your tax savings is about $1,200, a little over $1,200. However, you'd have to sell all $45,000 to save that $1,200 in taxes, which means that $45,000 investment only needs to appreciate by 2.7% to completely offset the tax benefit that you have there. So with wash sale rules, you can't rebuy something within 30 days. So it's very possible that that investment could appreciate a whole lot more than 2.7%, especially if it's a good investment. So in that case, it's only a 10% loss, might not make sense. However, let's say you had a $10,000 investment and it declined to $5,000. So now it's still a $5,000 loss, but it's 50%. In that case, assuming the same tax bracket, still saves you $1,200, but that now $5,000 investment would have needed to appreciate by 24% to recoup that tax loss savings. So a lot of times it comes down to what is the percentage loss that you have, not the dollar amount loss that you have.
Right. And it's so important because I know I agree with people. I hate paying taxes, but you don't just sell something just so you don't pay taxes because there's so many problems going to happen. And from the investment side, we look at too saying, I have seen investments rebound. I mean, the reason why the stock dropped could have been a temporary thing, and all of a sudden it rebounds, and then it goes up, and you sold it, and it goes up to, up 20, 30%. Well, if you buy it back after that 31 days, you then have a short-term gain when it does hit the target sell price. So there's so many factors that people don't understand about tax loss harvesting. They think, oh, it's a great thing. I know sometimes CPAs, accountants say, oh, it's a great thing. You've got to understand all the fundamentals. And you talk about all these other things too that you have to look at. It's not just a one thing you look at not paying taxes.
Yeah, exactly. I mean, no one likes to pay taxes. Even if, like you said, if it goes up, you saved $1,200 in taxes, but maybe you missed out on a $5,000 appreciation because that position went up by a few percent. But even if it doesn't, even if you sell, and in this case it was $45,000, and then you buy back and it's still the same amount, well, in that case, you reset your cost basis. So if it ever does rebound, now you have a larger gain in the future. There is some value to tax deferral, but depending on your tax situation, that might not actually be helpful. In people who are in retirement over the age of 65, your income can be up to like $150,000, and long-term capital gains are taxed at 0% federally. So harvesting a loss might do nothing because the gains that you have might be tax-free already. And so you definitely don't want to harvest a loss and then reduce your cost basis and then sell that position at some point in the future if you do happen to be in a higher tax bracket at that point. So you need to look at, what bracket are you now? What bracket are you later? What is the all-in benefit of harvesting a loss? And then what is the future consequence of that? And then, what could those investments be doing in the meantime?
The other thing, too, people don't understand also, and I'll let you go in a second, Chase, is that if you do buy back in 31 days, okay, great, fine. But you may have held that company for maybe 10, 12, maybe 2 years. You had a long-term gain. But then you buy it back after 31 days. Then it hits its target sell price 8 months down the road. Time to sell it because it's target sell price. Now you have a short-term gain.
Mm-hmm. Yeah, exactly. Now taxed at a higher rate. And so, the tax loss benefit that you have, when you harvest a loss, in many cases, the benefit is really a long-term gain that you're offsetting. So then if you have to realize something at a short-term gain, that definitely more than offsets it, or you have to continue holding something because you don't want to pay the short-term gain, well, then, maybe it becomes too risky at that point and it goes down. So there's a lot of different factors that go into it, and it's not as simple as just, well, I have this loss and I'm going to use it to offset my gains. Really might not be the right thing to do. Sometimes it is, but not always.
Yeah, I was going to say, I was having a conversation with a gentleman today, and he was talking about he had this company, it was CoreWeave actually. He got in early and it went up to 160. He's like, I was going to sell it at 160, but people are like, don't sell it because it's a short-term gain. I think now it's at 80. He's like, I wish I would have sold it. People get so fixated on, again, the taxation of it rather than the economic value of that business. And they will make that tax decision at their primary driving force as to how they're going to respond to buy and sell in different situations. And when we look at tax deferral, I really believe tax deferral is great for IRAs, for 401ks, because you can have a diversified portfolio that is growing tax deferred. With individual stocks, you don't really get a benefit from tax deferral.
It's not the same, and it's a good point to bring up, because tax deferral is helpful when you know you're going to have compounding growth, which in an overall account, that's normal. If you have a diversified portfolio in an IRA, the tax deferral is helpful because those gains can be fully reinvested without tax. So the tax benefit is there. When you have an individual position, individual positions don't always go up over time. So like in that example of CoreWeave, you would have liked to defer the gain, but there's no guarantee that it's going to continue going up, especially when you hold something risky like that. So in that case, it would have been much better to pay the taxes, take the gain, and move on to something else. And that's also a problem when you're investing in something that's speculative, because you have that fear of, well, I want to wait 12 months so I can lock in the long-term gain, but that means you have to continue holding that risk essentially. And in that case, a lot of cases it doesn't work out.
And there's some cases where you could be 22% tax bracket federally, and then
for ordinary income,
15% capital gains. State of California, it's the same regardless of your taxation. So it's like you could be saving 7%.
Good point. Long-term gains are always going to be taxed at a lower rate than their short-term gain counterpart, but you're right. In many cases, it's not that different. Both short and long-term are subject to the net investment income tax. If your AGI is above a certain level, both of them can trigger IRMA. States do not differentiate between long-term and short-term gains. They're all taxed the same. So you might be 15 versus 12, or you might be 0 versus 12, or you might be, whatever it is. But you're right. The actual real benefit of a short versus long-term gain might not be as helpful as you think.
There's a lot more to it than people think. And one thing I learned many, many years ago, and we apply here at Wilsey Asset Management, is never make a tax decision over an economic decision. You've got to look at the whole situation. You can't just say, sell it because I want to take the loss. You can't do that.
Yeah. I mean, sometimes people don't like to hear that, but at the end of the day, you want to make money, and you want to mitigate your tax bill on that, making money as much as possible, but you don't want to lose, much more than whatever tax consequence might be there.
Takes a little time. Can't do it a quick decision.
Yeah.
All right. Harrison, thank you very much. Again, that's Harrison Johnson, our financial planner here at Wilsey Asset Management. He's a CFP. If you want to talk to him or have a consultation with him, give a call here at the office at 858-224-0004. Again, that's 858-224-0004. Or go to the website, smartinvesting2000.com. Again, that's smartinvesting2000.com. Send an email. You can have that free consultation with him, and maybe you're taking taxes you shouldn't be, or not taking taxes you should be. You got to be careful. It's not an easy thing. It's just not.
No, I mean, it's tough. As you said, nobody likes paying taxes.
No.
But sometimes you have to.
You have to, because the economic benefit is better to pay the taxes than not. And you made a great point with that CoreWeave, gentlemen.
And then we have one client. He always calls taxes a champagne problem because you're not going to go broke paying taxes.
Right. Yeah. And I would rather make money and pay a lot of taxes than make no money and pay no taxes.
Yeah.